The ABCD swing is the basis of all price action, smart money concepts, or any other candlestick chart based approach to trading. The big market players know this, the algorithm knows too. That is how it is able to induce liquidity and hunt retail stop losses. In this video, I will simplify the concept of stop hunting while focusing on teaching you how to identify retail stop loss level with ease using fractals. Without wasting any of your time, let's jump right into the lesson. Every trader knows the pain of getting in a trade and price, instead of heading in your favor, decides to go straight to your stop loss and then head straight to your take profit level without you. It makes you feel as though the market maker is watching you through some hidden camera or telescope. The truth of the matter is that neither the market maker nor the algorithm can see you, and your position size is too small to be of interest to any big player. But if there is a pool of thousands or millions of retail stops at the same area, then the institutional trader becomes interested. Remember that the retail trader trades price action on candlestick chart, which is all about ABCD swings with entries at C and stop loss at A. When the big players spot the ABCD swing form, they know based on behavioral pattern and retail education that a lot of stop losses will be resting at the A level. They use that liquidity to load their positions. I explained more on this in our previous video on liquidity. You should try and watch that video for more details. The focus in this video is on identifying the A level, which is the level where retail stop losses reside, using fractal indicator. The fractal indicator helps us to achieve 100% mechanical approach to identifying retail liquidity zone. What are fractals? Fractals refer to a 5-bar candlestick pattern that marks reversal points on a price chart. These patterns consist of a series of 5 consecutive candlesticks, with the middle one having the highest high or the lowest low, surrounded by 2 lower highs or 2 lower lows. The middle candle is the fractal high or fractal low, which is automatically marked by the fractal indicator. The fractal indicator is available on most trading platforms. With the fractals marked on a chart, it becomes very easy to spot turns that make up the ABCD swing, as the A and C points are marked automatically by fractals. As you can see on this chart, here we have ABCD swing to the downside, and here we have ABCD to the upside. As you already know, the A point of every ABCD swing is retail liquidity. It is important to know how to quickly and easily spot such points. To do that, we use the fractal of fractals, but instead of 2 higher or lower fractals to the sides, we use 1. What that simply means is that a sell side liquidity is a fractal low with 1 higher fractal low on both sides, while a buy side liquidity is a fractal high with 1 lower fractal high on both sides. If you're yet to like the video at this point, please do that now by clicking the thumb up button, and if you haven't subscribed to the channel, do that also. Click the subscribe button and don't forget to turn on your post notification so you get notified whenever we post new video. Now let's go through these charts and mark all the retail stop loss levels using fractals. Right here at this eye, we have the highest fractal with lower fractal highs on both sides. That makes this the A point of an ABCD swing, which in turn makes it a retail stop loss level. To make the markings easier, I will focus on the highs and mark all the liquidity zones, then move to the lows. After this eye, the next eye with lower fractals on both sides is this one right here, with these two as the lower fractal eyes. Next we have this with this as the lower fractal eyes, then this, and finally this eye with this fractal and this one as the lower fractals on both sides. Now let's move to the lows. The first fractal low with higher fractal lows on both sides is this low right here, with these fractals on the sides. The next one is this low right here, then this one, followed by this one, then we have this. This low right here looks like a liquidity zone, but it is not, because it is not the A point of the ABCD swing. There is a higher fractal low to the left side, but the next fractal on the right side is lower. That invalidates this low as a liquidity zone. But the low created here is a valid liquidity zone, as we can clearly see this higher fractal low to the left and this one to the right side. After that, we have this low right here, which meets the condition for a retail liquidity zone. These retail liquidity zones are targets and can also serve as entry zones depending on the intended direction of the institutions and banks. The liquidity zones can also be used to read market structure efficiently in a mechanical manner. You already know that I'm not a big fan of finding market direction on the charts. I know for sure that the charts cannot tell the future direction. It only shows history of price movements. What really tells the future direction is macroeconomics and institutional accumulation. Members of our Telegram data channel can testify to that, because they have witnessed price action, SMC, ICT, and every chart-based approach to market direction fail woefully when the institutional orders are against it. It is because of how important the institutional data is that I decided to share it with interested members. The link to join our data channel is in the description of this video if you are interested. To get the best results with liquidity zones, we use areas where multiple untapped liquidity zones are. This is what is referred to as liquidity pool. Example of a liquidity pool is this region right here. You can see two untapped liquidity zones, which makes this low that covers both liquidity zones a liquidity pool. This means that if price can run the two liquidity zone on the down move, a reversal can happen if the institutions are accumulating buy orders at that time. The liquidity pool provides the big players the opposing orders to pair their buy positions with. Without access to institutional orders, the conclusion that the institutions are buying here is just an assumption, like every other chart-based analysis. If the institutions don't have buy orders in that liquidity zone, or they have sell orders instead, the pattern will fail smoothly as if it has never worked before. With access to institutional data, you will know that the institutional traders are accumulating buy orders in that zone, and certainly the reversal will happen. That's why I share the data in my Telegram channel. I explain more on how to use liquidity zones in our previous liquidity video. Do well to watch that video for better understanding. Don't forget to like this video and subscribe to the channel by clicking the thumbs up button and subscribe buttons. Also turn on your post notification so you get notified when we drop new educational videos. I'll see you guys on the next one. Have a great day.